Welcome to Smokin Bulls, the podcast about business, money, and lifestyle. Today we're talking to Paul Fauset from PPI about business planning insurance strategies for the corporate business owner. I'm Tyler.
I'm Dave.
Let's get into it. Paul's been in the insurance industry in a variety of capacities for over 25 years. He's worked as a sales manager for disability insurance, sold a variety of insurance solutions to the general public, and worked as a life manager and broker manager assisting advisors in their business, among many other things. So Paul, we're going to be chatting, I guess, with you about a couple of concepts that might be applicable to our client base, stuff that we actually have used in our client base for a few clients, and it's stuff that you've supported us with and helped us work through with some of our more complex cases. Before we jump into those concepts, maybe tell us a little bit about how you got started in this business.
That's an interesting story, actually. I think like a lot of people in our business, I didn't wake up one day and say I want to go into the insurance industry. I actually started out working in the banking industry, and I had clients working with checks and visas on high-end clients for a major bank. And I decided I wanted to get into financial planning, and I ended up taking my mutual fund license. And ironically, it was actually the disability company called Paul Revere, and I ended up becoming a wholesaler doing insurance instead of investments. So sometimes things take a little bit of a deviation. And I really, really enjoyed the business and found that I really had a passion for it. So that led to me getting some designations and moving forward to more complicated strategies.
I think you're right. I mean, I didn't set out in life to become a wealth manager, and I don't think Dave did either. So it's funny how we stumble into what we do. They make you feel like when you're in school that you need to have it written down and know exactly what you're going to do when you've finished your education, and it's very rarely like that. So what's something that most people don't know about you?
Probably a lot of things, to be honest with you, but
You're a Bills fan.
Actually, an avid Toronto Blue Jays fan. I grew up in Toronto and actually went to the World Series back in 92 and 93. And I've actually gone to see them in New York, Anaheim, Seattle, down in Texas. And the way you arrange this, if you have a family, I'll just give a tip to your clients here, is you tell your family how fun it will be to go on a vacation to Seattle, and then you cross-reference that with the schedule. And then you actually make sure you go when the Jays are there, and lo and behold, you go to the series.
Yeah,
So I've actually collected signed photos, jerseys, baseballs, and really, really enjoy watching them. So yeah, that would be something, I guess.
Good for you.
I like how you said you tie it all together with a series. Some people are like, catch a game. He's going to the home stand or the visitor stand, the 3-game series. Nice.
Right on. Well, thanks for sharing that stuff with us, Paul. Maybe let's dive in a little deeper now into the concepts that we want to talk about today, or that you thought would be a good topic for us to speak about. So maybe let's start with the first one. I think you've got 2 ideas that you want to share with us. What would you like to chat about first?
Well, I'll just give you a little bit of context and background of what we're talking about. A lot of times when people hear insurance, they're thinking, oh my goodness, insurance, I don't want to talk about insurance. But for a variety of reasons in the last 10 or 15 years in Canada, insurance products have morphed into quasi-investment products. And we're going to talk about 2 strategies today. And the reason for that is, just to remind some people that are listening, right now, if you have a corporation in Canada and you invest inside the corporation, you've got a passive investment tax rate of 46+%. So that's quite a drag on your actual returns. And then when you try to pull the money out, you've got a 42.3% dividend tax rate. That's just the way it's going to work. So if we took $50,000 and used Dave's tutelage and knowledge on investing, once we pulled it out of the company after the first year, we'd end up with $30,000. So that's not a very favorable result. And we've also seen the government in the last few years come up with very punitive rules on income splitting and that kind of stuff. So these avenues have closed down. And dare I say, they'll probably be closing down more in the next 5 or 10 years, just based on accumulated debt and other factors. So what we've arranged are 2 products that actually benefit from existing tax rules. With insurance products, unlike the passive investment tax rule, any investment embedded in the product grows tax deferred. So we don't get that drag of that passive investment tax rate. And benefits out of insurance products are tax-free. So we got a couple of neat things going on here. And when it comes to life insurance, the death benefit not only comes into the corporation tax-free, but it goes through the CDA account, the capital dividend account, and can come out in enough time, perhaps 100% tax-free. So what you get are much better efficiencies with your money. So when people say, as I mentioned, I don't like insurance, first thing I say is, well, this isn't really about the insurance. We have some really good protection here. But what I want to talk to you about is an investment strategy, let's say an alternative investment strategy to utilize your money better. That's kind of the way we look at this. Now, the two products that I want to discuss today are two solutions. One of them, some people call it the Executive Health Savings Plan, and the other one is a estate bond. So we'll delve into the Executive Health Savings Plan in a couple of minutes. I'm going to have some slides pulled up. But what we're going to do here is we're going to provide valuable critical illness insurance, but we're also going to provide an avenue for the executive to get money out of the company in a tax-efficient way. So not only are they going to get this protection, which they need anyways, but they're also going to be able to get money channeling out of the company and be able to get it to avoid some of those tax problems we looked at earlier. So when people see this, and we're going to go through this, I quite often get people saying, well, what's the catch? This looks too good to be true. And that's just because these products have just got some embedded abilities in them that you don't see with other products. So what I'd like to do maybe to start with is if we can pull up the PowerPoint on the first concept, and I'll go through a few factors and information, and maybe I can just walk you folks through how this product works. So as I mentioned, I think this concept has some really phenomenal benefits to it. And it's easier to explain by going through a couple of graphs and a little bit of information. And once you see some of the graphs embedded in this PowerPoint, it'll become much more, I think, useful to you. And a little bit of background on critical illness. It was actually invented by a heart surgeon in South Africa back in the 90s. And the product was invented because he was actually doing revolutionary surgery, saving people's lives. But he realized people were becoming bankrupt and losing their businesses and homes because they didn't have protection. And when you're a business owner, think about this yourself. If you actually couldn't work due to a critical illness, you have lost revenue, you have your knowledge not there, you could have real profitability issues. So what this product does, we'll just go to the next slide, is it actually pays a lump sum amount of money, tax-free, if you suffer one of the listed critical illnesses on the actual product as listed. The top three, representing almost 85% of critical illnesses, are heart attack, cancer, and stroke. That represents quite a majority of cases. And just think about to yourself, if you were a business owner and you couldn't actually work, how would that affect your ability to, would you like to have money to help you get through that? Now, we also look at some of the stats in Canada. And pretty somber stats, actually. 1 in 3 Canadians will develop cancer. 1 in 9 females will get breast cancer. So the coverage itself, and I want to emphasize this before we get into the strategy, the coverage itself is very valuable coverage. We do have public health care, but there's a lot of costs that aren't covered, whether it's travel, staying in a hotel, maybe convalescing at home. And this allows you to get money given to you after surviving the illness. And unlike a disability benefit, it doesn't matter whether you can work or not. It's did you have the illness, and the money gets paid to you. So regardless of whether this strategy was for you, even if you were just looking at valuable coverage, this would be something you'd want to look at. So in the next slide, we can kind of see how this works and why it fits into a corporate strategy. What we're doing here, some people call this split dollar critical illness. We're buying critical illness through our corporation. And the corporation is going to pay with corporate tax dollars. So that's a benefit in itself if you're under the small business tax rate. We're going to use corporate tax dollars to pay the premium for the critical illness benefit. The actual executive is actually going to pay the premium for what's called a return of premium benefit. And that's going to give the person all of their money back after 15 years with most companies if they so choose. That's guaranteed. It's not an investment. It's not open to fluctuations. It's a guaranteed amount of money, providing you that money in the future. So what we're doing here is we're taking money out of the corporation and we're going to have it presented to us in the future outside the corporation as a guaranteed lump sum amount of money. So the graph here is showing us, in this particular case, I used a 38-year-old female. She's going to invest in a product that's paid up in 15 years, guaranteed, for $1 million critical illness benefit. The premium's just over $25,000, and the company is going to pay the lion's share of the cost, like just about $23,000 plus of that. She's going to pay and be audited like through her accountant, make sure Revenue Canada sees this. She's going to pay for the return of premium benefit with after-tax dollars. That way, there's no disposition at tax time when she gets her return of premium. So you can see now here that the company's paying the majority of the cost at a corporate tax rate. She's paying a little bit of extra to ensure that she can get her return of premium. And it's going to be shared ownership. So the company's going to have a shared ownership agreement, and they're going to have the company own the critical illness benefit, and they're going to have the executive own the return of premium and the death benefit. Is there any questions at this point, or should we jump to the next slide?
So the return of premium benefit that the executive owns, that's owned, just so everybody's clear that's maybe watching this, that's owned personally. So it's not a corporate ownership. That personal ownership then creates sort of this pathway for the return of premium to follow out of the company and into that executive's hands at the 15-year mark.
That's right. And if we didn't do it that way, of course, then we'd have the money stuck inside the company. But because they've owned and paid for the portion that's the return of premium, there is no issues at tax time within the company.
Okay.
So next slide kind of just goes into a little bit more detail on how this would work. And remember, this is based on a 38-year-old female. But the company, if the particular individual here did have a critical illness, the company's got $1 million paid into the corporation tax-free. They can do whatever they want with that money. There's not a list of rules like you have to use it for this or you have to use it for that. It's just guaranteed money paid to the company. They could look for a replacement. They could cover overhead expenses. The person could take it out of the company for their own personal needs. Lots of variety in what they want to do. Because they paid for the return of premiums, we mentioned the death benefit, if something happens in either of those areas, they're going to get that payment. And the next slide actually, I think, puts this in the best position. This is kind of the aha moment for most people with this strategy. If you pay the premiums and have this in force, you're guaranteed to get one of these three checks. If you have a critical illness, as I mentioned, you're going to get $1 million into your company. If something happens to the executive, this is where it gets really, really interesting. Let's say the executive passed away at age 48. It doesn't matter what she passed away from. It doesn't have to be one of the listed conditions. But she has an unfortunate bunch of circumstances and passes away. Well, she gets a death benefit of over $250,000, which at that point represents the cumulative return of premiums. What we want to show her and what she's hoping for, obviously, is in year 15, she can come back to the company. In this case, we used Manulife just to show you the strategy. And we're going to give her a check for $376,000, 870 tax-free, non-registered money. At that point, she may be starting to think about retirement. In the meantime, she's channeled money out of the company tax effectively, and she's given herself valuable protection in life insurance plus critical illness, and she's provided a way to get some of those funds out of the company. The next slide actually shows us what this looks like. And this is a very important slide to look at because what we're looking at here, and this comes up quite often with people when I show them this strategy, is they say, I've got this really hot shot investment guy named Tyler. I think I can get better investments inside my company. In fact, what if I got 5% for the next 15 years for these premiums you're showing me? What would that look like? And if you do that math by itself, you may think to yourself, well, I'm better off investing, because when we look at the bottom figure here, we end up with a amount of $468,000 inside the company, which is higher than a critical illness amount. But what that's not taken into consideration, we mentioned earlier about some of these tax problems are going to happen. They've got to get that money out of the company. So if you look at the numbers on the bottom, hopefully your viewers can see that. They would actually get that money paid to them, the $468, but then they'd have to pay a dividend tax credit to get that money out. which would net them $270,000 plus dollars, they're actually going to be better off by $106,000 with return of premium.
And they did that risk-free, right, Paul? There's no exposure to risk there. As you mentioned, that's a guaranteed return of premium. So there is no having to bet on a 5% return or gamble on a return there.
Absolutely. And again, it's not going into something that's, like an RSP or it's stuck inside there and you got to get it out. This money is a nice little way to say, what if we took a component of some of your money out of your corporation and we put it into a vehicle that's providing the protection, plus you're going to guarantee this amount of money. Doesn't matter what the statements say, this is just guaranteed. So it's, like I said, it's a neat way to give them some money out of the corporation. This really shows you on this page, can you get a guaranteed 5% rate of return for the next 15 years on the environment we're in right now? Most likely not. So this slide actually shows that and just says at the end of the day, this strategy is going to give you all those protections, plus it's going to give you the return of premium in year 15. And again, that's not mandatory. If this particular individual decided, I really want to keep this coverage in force, I think it is valuable coverage. Well, she's paid up in 15 years and she can keep it going. She'd have that coverage in place for however she wanted. So it's a really beautiful thing. And right now, under the Income Tax Act rules, this would actually all work. You've got to have a legal agreement on split dollar ownership. You've got to keep track of the premiums being paid by who and when, and then you're off to the races.
So if there is a critical net benefit of the $1 million that pays to the corporation, it's not like life insurance where it passes through the CDA and out to a shareholder tax-free. This would come out as a taxable dividend to a shareholder.
That's a good point. Yeah. I mentioned that slide a few slides ago with the 3 checks, and people look at that and say, well, what's the catch? There's got to be some catch here. And what you just said, Dave, is quite often I have to mention to people that you are paying with corporate tax dollars at a much lower rate. The money now is in your company. So if you did want to access that money, you would have to pull it out of the company, just like you would for dividends or salary. So there is that to consider. But in the meantime, you're using a much lower tax rate to get it done. So, good point. And now, if you actually look at this, just go through a few more slides here quickly. When we look at what the amount of money that she's paying out of pocket, remember her company's paying the majority of the premium, but the health benefit, which is really return of premium, she's actually paying that amount listed on the screen there. You'd have to earn a 33% internal rate of return in order to equal that on her investment. And I mention that because the coverage in itself is very valuable coverage, and that's something you'd want to have anyways. So if we have the coverage and I can get you to pay a little bit of extra money out of your pocket, you're never going to earn these rates of return. So it's really something when you look at that and say, this is really, really neat. And the next slide kind of just shows the death benefit option, which is even more profound because that premium's very low and you have higher rates of return there that's the health benefit after 11 years on that slide. And it's just showing you a different perspective. The next slide actually shows you, as I was mentioning, the death benefit. And again, you're getting into astronomical rates of return here, 64%. So if this person did end up passing away in year 11, the amount of benefit you're getting back, you'd have to earn 64% in order to equal that, which is pretty much impossible. So the only other thing I'd say when people say, what's the catch? You do have to qualify for these plans medically. And it is a tougher insurance to qualify for than your typical life insurance policy. So when we do look with clients on these, one thing we do is we do ask them some, it looks more of genetics and family history and that type of stuff. But that's the only catch. You've got to take it out before age 55 and give it some time, 15 years, and you're off for the races. Once it's issued, like any insurance contract with most companies, it's guaranteed. The company can't change the wording. They can't cancel it on you. You can take it with you wherever you go.
I've often said to clients, Paul, about the underwriting, the fact that it's more difficult coverage to obtain, and there's a reason for that. It's because you're more likely to claim on it. That's why they make it harder to get.
That's just it, right? It's all based on actuaries doing risk assessments, and that's what you're really looking at. So that's what we're looking at. The next few slides kind of just look at the same numbers we looked at based on different time horizons for the death benefit and so forth. But that's kind of the main concept. What we're doing here, just to kind of summarize what we looked at, is we're buying critical illness insurance through our corporation. And we're adding a feature, a rider called return of premium and return of premium at death. And the company's going to pay for the critical illness coverage with corporate tax dollars. We're going to pay for the other benefits out of our pocket. And what we're doing essentially is funneling money out of our company in a much more efficient manner than what we've seen with some investments. So that's kind of the first strategy that I really wanted to cover.
That's a great concept, Paul. And I think one of the things that I would key in on in it, and I bring this up with clients as well, is when you're talking about the covered conditions. I know a lot of people will look at those, and sometimes you look at the numbers and can't believe that they're true. 1 in 3 Canadians suffer from a critical illness, I think was the number that you showed on there. One of the covered conditions is loss of independent existence. And sometimes I'll bring that up with clients because maybe they don't have a history of cancer in their family or Parkinson's, or they've got a healthy family history. And I will mention to them that loss of independent existence is on there. Can you describe maybe what loss of independent existence means? I know what I say, but I'd be curious to hear how you speak about it.
And I'm glad you brought that up. A few years ago, a lot of carriers in Canada had a coverage called long-term care coverage. And it basically paid a benefit if you couldn't do 2 or more activities of daily living. The product didn't sell that well in Canada, I think, because unlike the U.S., people perceived that there was some public health care here. But the CI contracts have picked up the slack, and they're actually now saying, well, I'll tell you what, if you actually get into a severe type of situation, whether it's Alzheimer's or maybe some sort of serious car accident with cognitive decline, if you can't look after yourself, we'll actually pay a benefit out of the CI benefit. Each contract differs, but it would take the $1 million and pay it out in kind of increments to help the person deal with that. So it's another very valuable feature. And if somebody came to me and said, can I get some long-term care? This would be something to look at that would be give you kind of 2 products for the same situation.
Yeah, I agree. Dave and I attended a conference once, and the lady that was speaking at the time was talking about long-term care coverage, but she was speaking about positioning long-term care with a younger generation and how it's been claimed on before. And I think she gave the example of a roofer who had fallen off the roof, broke both of his arms, and right there he's in traction basically, and he had lost his independent existence for a number of months until he was healed. So he needed home nursing care to look after him, and that was a claim. So I found that pretty unique. Guys may not think of that when they hear critical illness. They may not think of loss of independent existence being a serious injury. So,
and long-term care, people just think of long-term care home.
Yeah.
That you're elderly or retired or things of that nature.
Yeah. So it's
before I move to the next topic, I'll kind of leave this thought. I used to work with a fellow, and he used to run seminars on critical illness insurance. And what he would do is, standing in front of a group of people, is he'd say, all of you standing in this room, do you know anybody that's ever had a stroke, heart attack, or cancer? If so, stand up. And of course, the majority of the room stood up. And the next question would be, if that person, after their serious condition, was given a check for $250,000, would that have made a difference? And that's, again, why the whole product was invented. A doctor, Dr. Maurice Bernard, saw people just getting destroyed mentally and physically because they couldn't pay bills or cope. So that's really the value of the coverage. But in this case, we're coupling it with existing tax laws and giving corporations a huge benefit.
Yeah, absolutely. It's a great strategy, and it's one that we've used with some of our corporate clients. So thanks for sharing that one, Paul. What is your next topic? Are you ready to move on to the next one?
I think so. So the next corporate estate bond, which is just really a tag name for it. But we're going to do the same thing. We're trying to find a way of, how do I get money out of my corporation tax effectively? If in this particular circumstance, we've got a holdco or PC or opco, and I've got money inside that company, and I'm thinking of investing it. And my end goal in this case is I want to leave something for my loved ones. So the motivation here, there's other strategies we do with people, but this one would be, I've got money in my company. Do you have a way that I can get it out and leave a better benefit to my heirs than the existing situation with the passive investment tax rules, the dividend, the potential capital gains. And that's what we want to show people. The same client, we're going to use a 38-year-old female. And I should mention, a lot of these strategies work really well as long as you don't wait too long. For a executive that's maybe between the age of 30 and 50-ish, and then you can get some really good results from it. So this is kind of the printout I wanted to show on this particular product, creating a corporate estate bond. And we'll just go through, again, a reminder here on the next slide of some of the concepts. With life insurance rules in Canada as they stand right now, life insurance money that goes into a permanent product with additional investments goes into an investment account or a paid up addition account. It grows tax deferred. So that can be put in there overfunded for 5 or 10 or 20 or 30 years. You're not going to get any sort of a tax bill at the end of the year for that, like you would for any investment inside your company, or you would for a non-registered or non-TFSA investment. So think of the extra money you're making in retained earnings, and we're dumping $10,000, or in this case, we're going to look at just over $19,000 a year for 20 years. We're going to put money into this year after year after year. She's getting the money out of the retained earnings. She doesn't need it for immediate operating cost, and it's going to grow tax deferred, which is going to go towards building a death benefit, which, just to remind everybody, that will eventually be a tax-free death benefit as it builds up a credit in the capital dividend account. So we'll go to the next slide, and just kind of, this is a review of basically how it works. And what we're doing here basically is we're going to have the corporation purchase life insurance on the shareholder. The corporation is going to be the owner and the beneficiary of the policy. Depending on the person's budget, they're going to put excess deposit into the insurance. So the insurance may only cost $8,000. She's going to put an extra amount and top it up to build up that cash value. And again, that's going to grow tax deferred. There's going to be no taxes on that going forward. And at death, if we use this for a death benefit, the death benefit's going to actually come out of the capital dividend account and bypass any punitive taxes we may face. The next slide really shows this in action. This is really a side-by-side comparison. We're going to do a similar analysis where we say the person comes to me and says, I want to invest over $19,000 for the next 20 years. I think I can earn 4%. How does that compare to what you're showing me here? And that goes year by year by year, and it's showing what your rate of return is each year. And it's also showing you the refundable dividend tax on hand, which comes back to you if you pull the money out of the company, and what you would net as a beneficiary of the policy. And it goes right down automatically in this particular program and calculates what would happen at life expectancy. This isn't based on her personally. This is just based on an average statistic based on statistics in Canada. So she would pass away in year 51. And the result, you can see with the arrow there, would be a death benefit of $1.5 million. And if she did the investment strategy right until the day she died, she's looking at $700 and some odd $1,000. So it's 2.19% better to do this. And she ends up leaving a lot more money to her beneficiaries. And in fact, she'd have to earn over 7% rate of return in order to equal this strategy. So,
that's 2.19 times multiplied. You said percent, so it's almost double.
Multiplied by. So you look at this and say, when people come to us and say, you know, I've been a very successful business person. I've got a lot of money stuck inside my company. I just talked to my accountant, and apparently there's not very favorable tax consequences. I have some lovely kids and grandchildren. What can I do to get this money out? This would be a strategy. It does take time to build up the capital dividend account credit, but it does definitely work. This particular program that I'm pulling up here, if this doesn't work for you, it won't run the program. Just to reiterate, these aren't marketing pieces. This is basically saying, let's look at the numbers for you personally and see if this works. And if it doesn't work, it doesn't work. But this will work 99% of the time just because of the existing structures. And I would almost say, again, just to reiterate, with what we've been through in the last year in Canada, and Alberta, I can't see tax rates going down or getting more favorable at any time. So these strategies may be really, really good ideas now to look at in order to get some stuff moving forward in a positive fashion.
Yeah, I think this is something we've employed before with our clients. Like anything, we view it as a wealth accumulation or, like an investment from a comparative point of view. And, first and foremost, we're trying to make sure our clients have a retirement. And many of our corporate clients do have money built up in their corporations or their holdcos, and it's money they're not going to use. So the right thing to do is to look at alternative strategies that we can use, such as this, to help extract that money from the corporation in the most tax-effective manner. So it's something that's brought up all the time for us. It's just a matter of finding that sweet spot for a client of how much they think they need to have available. And I without getting too detailed on a policy like this, there are ways to access some of the monies if needed, but that's not necessarily the strategy we're talking about here.
Yeah, absolutely. So yeah, like any other strategy, there's no be-all and end-all solution. And we talk to clients and with folks like yourselves and look at what they're trying to achieve and what their goals are and what their health situation is. And if it does fit, we look at it. And I'd also mention that we're not representing one company. We'll go to half a dozen insurance companies and make sure we get the best product and the best fit. So the next slide just kind of shows, again, reiterating that slide, just the percentage of how much better this will be at each given year percentage-wise than the alternative investment. And you can see on there that right across the board, the net result based on existing tax rules make it a much better way to get money out of your corporation. So that's really it. Again, what I say to people, if they say I need the money for different things, well, then we don't want to take the money out. I want to use the money for some other feature, well, then we don't do that. But when we do have people that come in and say, I need to do this, they can do it. And a very common one is joint last to die. And that brings the insurance costs down quite a bit and allows them to accumulate the growth until the last death of the spouse.
Right. And why would somebody in this situation want to use a joint first to die?
In those kind of situations, again, we go through a discovery with people and we find out what their time horizons are and when they may want to see this happen or what the needs are. Sometimes people are going to wrap the company up in a matter of years, or they have plans that coincide with that. So that's stuff we take into account with our clients, is just ask them those kind of questions is, when do you need the money? How much can you afford? How long do you want to pay for? That kind of stuff. So there's different, okay. We look at it and specifically look at situations.
These are some pretty cool concepts, Paul. I mean, they're common to us because we see them all the time and we're, in the weeds with it all the time and looking at these and trying to find the right client for it. If you're speaking to an audience like you are right now, what's the one takeaway that maybe you would want them to absorb from seeing some of this information? Because it's probably maybe new to them if they haven't got an advisor such as us who's brought it forward to them. But what would you want them to take away?
I think I'd use the word, and I'd say this for most of my career with most insurance products. If I had to use one word, procrastination. And I say that really heartfelt because what I've seen too often in my career is people call up and they've got I've had these calls literally 84 years old. And can we do something like this, Paul? And if you want to do these strategies, the younger you are, the better results you'll get. You'll probably be more insurable and it will be more affordable. Insurance, just think of it from an actuarial standpoint. If you're 84, the actuary is thinking you don't have too many more days left on this earth. We're going to have to charge you a lot of money. If you're 38, like our example, it's going to be less expensive. Also, people call up and they say, I just had a health challenge. Can I buy it now? And unfortunately, that gets much more tougher. And if you do get it, it's more expensive. So the one takeaway is, if you like these strategies, go talk to somebody sooner than later and, commit. You can always change your mind down the road. This isn't a contract where you're locked in for 10 years. If you don't like it, you can move away. And in actual fact, because of some changes in the tax laws, if you did change your mind after 4 or 5 years, you could actually probably get majority of your cash out of the policy with no tax consequences. So Yeah, don't delay. Look at it. Contact somebody that's reputable, and act now instead of later. That would be my takeaway.
That's a good point. I think we've run into that plenty of times with clients, and I've probably come to you with cases where their clients saying, I need to be able to do something like this, and they're too old or they're uninsurable, but they realize, oh shoot, I missed the bus on this one. I should have been acting on this a lot sooner.
Or how many do we propose to and have a discussion about? And it's, because it's not a traditional investment, it's a little bit baffling sometimes to them, and they're afraid sometimes because they think of 15 years or 10 years or things of that nature. Maybe liquidity is an issue. So there's a lot of things that happen when we have a discussion about this that can throw people off.
It's go through the numbers and look at the person's situation. We always make sure they're comfortable with what we're proposing. And maybe if they do have $1 million of retained earnings, we certainly don't want you to do this 100%. Let's take 30% of that and look at the strategy.
For sure. Yep.
Great point. Now, a little bit of a switch gears here, but life insurance industry is maybe frowned upon perhaps in Hollywood or maybe in media even, and you hear life insurance agent, and some people have a tainted viewpoint of that. What would you say about your industry? What's your takeaway point about your avocation?
Well, I think you make a good point there, Tyler, because when people read newspapers or look at things online, usually they're looking for sensational stories. So you always read the story of the Bernie Madoff types and somebody that pulled some shenanigans. But I know from a career in insurance that 99.6% of life claims are paid, and the ones that aren't paid are usually due to major non-disclosure forms. So I would say to somebody, like, you're looking at a kind of a convoluted view when you look at the way our industry is portrayed in the media or in movies, and find yourself a qualified financial planner with some experience, with some designations. If you need to get some referrals, do that. And you'll find that the sooner you act, the better. Again, I'm going to use that word again, procrastination. And I speak from personal experience. I was at a Toronto Maple Leaf game years ago, and I looked at a billboard, and it was Mackenzie Mutual Funds. I said, what is that? And I called the lady, and she told me I needed to start investing money for the future. And I can't afford that. I'm only like 21 years old. Oh, no, you got to do it, Paul. And that made such a difference in my life as far as buying a house, accumulating capital, having freedom. And it was all talking to somebody. So you just need to make sure that not everything you see or read is true, and sometimes those are the exceptions. And that's what I would say my one thing to keep in mind is.
Great.
Really good.
Well, those are good topics, Paul. Thanks very much for sharing them with us. We're going to switch gears a bit right now and talk about our smoking topic. And I think what Paul wanted to talk about in terms of a sort of a current event would have been electric cars and the shift to driving EV or green. What's your thoughts about that, Paul? Is Tesla going to take over, or is what's your future in electric cars look like?
Well, it's an interesting topic. I actually, full disclosure, I drive a Prius. And I got into this discussion with an advisor a few hours ago on the phone, and actually, this is quite a heated topic. So we see Elon Musk in the news almost daily, and we're looking at SpaceX, and Tesla's forever in the news. It's the media darling. Everybody loves electric cars. And it's usually, we have the U.S. now putting new legislation in to promote electric cars and get a grid set up and all that kind of stuff. The fact is, though, that at this point in time, for a couple of different reasons, the Prius is a more environmentally friendly car than a Tesla is. And the reason for that is that there's a 10,000 to 40,000 pound carbon debt when you produce a lithium battery right off the bat. And before you even get that car off of a Tesla lot, that's going to cost hundreds of thousands. It would take hundreds of thousands of kilometers of driving to get rid of that debt. And people have actually done studies on this in the States recently. And in 40 states, it was shown that a high efficiency conventional gas powered hybrid like the Prius is actually better for the climate. And it produces what people call life cycle carbon emissions. And the other factor taken into account on these studies is where's that electricity coming from? So when you buy the Tesla and you plug it in a lot of states in the study that was done, your electricity is coming from natural gas and coal. And when you take that into effect, you're never going to equalize the benefit of a Prius. And I see you guys aren't doing fistcuffs yet, so I'll keep that. And that may change because the study did show that in jurisdictions where people actually were switching over to renewable sources of generation of electricity, you do end up seeing better results. But if I was actually making decisions for a country now and I said I really want to make an impact for the next 10 or 20 years, I would be like Paul Fauset and I'd drive a Prius. Because the Tesla, again, with the existing technology we have, would actually not be as beneficial to the environment as a Prius.
So I mean, I don't drive an electric car, and I guess being from Alberta, it's almost like something you're not supposed to do. But even in that sense, until I can plug my car in and charge it from what I would consider to be renewable power, I don't feel like I'm making a big enough difference. Like, if we look at the big reset or all of this pandemic spending to get to net zero, you're going to have to produce a lot of resources to get to this situation. So we're gonna burn a lot of natural gas, a lot of oil, a lot of metals and minerals to get to this point in time. And so, I don't think a lot of people don't want to think past step one. They just want, I drive an electric car and I'm better for the environment, type thing. I think there's a lot of other factors in play. And, there's a lot of pieces that people don't want to talk about. They don't want to talk about nuclear. They don't want to talk about other ways that we can, everything has an environmental impact to produce energy. It's That's what right. has the least impact. And people, I think, they go to solar and wind because, they believe it doesn't have much of an impact, whereas it has a substantial impact because it takes a lot, like you said, that carbon footprint to produce those before they even turn some power for you. It takes a lot to get them there.
That's right, absolutely. And the other two factors is living in Edmonton here is you can lose a lot of efficiency when it gets very, very cold with a 100% battery car. And then there's the range anxiety issues also.
For sure.
I actually was running the Prius when it was minus 2,000 here a few months ago. It was like minus 56 or something, right? And even on the coldest day not plugged in, it did start. And it's still getting better efficiency than a 100% gas car. And it's just, it is a real reality now, again, until technologies get superchargers and somebody finds a way to maintain the energy in the battery. Right now, a Prius would be a better choice for the environment. So.
Yeah, well, that's a lot of things that need to change, I think, to get there. But that's what the big push is. I think eventually we'll see it. You look at your cell phone outside at minus 25, minus 30. If you're on a ski hill, it's in your pocket. It does not last anywhere near where you think it is. Try making that call at the end of the ski day to meet for a beer. Your phone's done. So you just hope you find them. Type of thing. So, yeah.
And I also find that there's a subset of people that aren't buying electric cars just for the efficiency of them or the green concept of it. They're buying them for the performance of them. Tesla's obviously proven to be a high-performance vehicle, and I think they're also buying them for convenience, the ability to just plug in at home and not ever have to worry about visiting a gas station again or deal with oil changes or some of those more typical, combustion engine maintenance issues that people deal with. So I think that there's a lot of people out there just buying them because they want that convenience. They could care less about environment, and environment isn't their driving purchasing factor. So it's interesting to see that there's a whole push to buy these vehicles just for those reasons.
Absolutely.
Yeah, I guess you could say your Prius is the piece that everybody should use until we can fully convert our system to electric. So
I think right now it's, again, from what I've seen when I've done reading on this and studies, and for the next 10 or 15 years, and eventually that may have a tipping point, but it's going to take a while.
Thanks for joining us for this episode of Smokin Bulls, the podcast about business, money, and lifestyle. To find out more about us, you can find us at smokinbulls.com or follow us on our social media.